A shocking revelation has emerged, highlighting a potential injustice in the car loan scandal redress scheme. Consumer groups and claims firms are outraged, claiming that victims could lose out on a staggering £4 billion in compensation due to an insulting interest rate proposed by the Financial Conduct Authority, FCA. But here's where it gets controversial. The FCA is accused of offering a reduced interest rate to borrowers affected by the car loan commission scandal. This rate, at 2.09%, is significantly lower than the 7% believed to have been awarded to Marcus Johnson, the sole driver whose case was upheld by the Supreme Court. Johnson's case set a precedent, and now consumer advocates are demanding equal treatment for all borrowers. The FCA estimates that victims will receive an average of £700 in compensation, resulting from 14 million unfair loans. However, critics argue that this estimate is based on an unfairly low interest rate, and that victims are entitled to much more. According to the FCA's own documents, the proposed rate will result in a £4 billion loss for drivers, a figure that has sparked outrage. Darren Smith, managing director of Cormax Legal, calls the FCA's proposal insulting to the millions of victims who were overcharged. He questions the hypocrisy of the lenders, who would never accept such a low rate for themselves in a commercial dispute. Smith's statement reflects a growing sentiment among consumer advocates and claims firms. The scheme aims to resolve the scandal surrounding unfair loan commission payments made to car dealers by banks. However, the proposed interest rate has become a contentious issue. When considering administrative costs, consumers are set to receive £9.7 billion of the £11 billion total, but this sum is calculated based on the 2.09% interest rate. If the rate were closer to the historical 8%, consumers would be entitled to £14.3 billion. Martin Lewis, founder of MoneyExpert, agrees that the interest rate is too low. He plans to raise the issue in his response to the FCA consultation, adding his voice to the growing chorus of criticism. Kevin Durkin, who represented Johnson, also believes the FCA's proposals are unfair and do not adequately compensate consumers for their years of suffering. Consumer advocates like Alex Neil of Consumer Voice echo these sentiments, arguing that the proposed rate is unacceptable and unworkable for those already burdened by the mis-selling scandal. However, the Financing and Leasing Association, FLA, defends the proposed interest rate, stating that it aligns with changes made by the Financial Ombudsman Service earlier this year. The FCA, in turn, justifies its rate as fair and proportionate, linking it to the Bank of England base rate. This issue has sparked a debate, with consumer groups and claims firms on one side, and the FCA and lenders on the other. The question remains, will the FCA's proposed redress scheme adequately compensate victims, or will it further rob them of their rightful compensation? The controversy invites discussion and raises important questions about fairness and justice in financial redress schemes.